AI stocks are on fire. NVIDIA, Microsoft, Google, tech giants are pouring billions into data centers, new models, and faster chips. And investors are loving it. But not everyone is convinced this is sustainable. Torsten Sløk, the chief economist at Apollo Global Management, has a warning. He says the current AI boom could actually be bigger and riskier than the dot-com bubble of the late 90s. We're talking about a period when startups with no revenue were being valued in the billions, only to collapse practically overnight. According to Sløk, the valuations we're seeing today among the top 10 AI companies have already surpassed those dot-com era highs. And he's not wrong. Let's look at what's happening. Meta is building a data center called Hyperion, designed to power its AI ambitions with 5 gigawatts of computing power. That's the kind of energy a small city might use. It's part of Meta's plan to leap ahead of OpenAI and Google in the AI arms race. Not to be outdone, OpenAI, along with Microsoft, is working on a project codenamed Stargate, with an estimated price tag of $100 billion. It'll also require 5 gigawatts of power. And Google? They're investing over $13 billion just this year into new data centers in the US. All of this shows one thing clearly. Building, training, and deploying cutting-edge AI models takes enormous amounts of energy and money. And here's where it gets even more complicated. Experts project that AI data centers could consume 20% of all electricity in the US by 2030. That's a fifth of the country's power use just for AI. In some areas, like Georgia, where Meta's building its new site, local communities are already starting to feel the pressure from these energy-hungry projects. Meanwhile, Wall Street is celebrating. The Nasdaq Composite just hit an all-time high, despite a modest daily gain of only 0.4%. But look under the hood. The index's trailing price-to-earnings ratio has jumped to 25.41, well above the 5-year average of 21.99. That's a red flag. It means investors are willing to pay more for earnings, betting big on the AI future. But what if that future takes longer to arrive than expected? The reality is, most of AI's current breakthroughs like ChatGPT or AI image generation are still incremental. They're impressive, but not revolutionary for most industries yet. The real game changers, like fully autonomous systems or practical quantum computing, are still just over the horizon. And let's not forget inflation and interest rates. The Federal Reserve is projecting 3% inflation for 2025 and a median federal funds rate of 3.9%. That means borrowing money isn't getting cheaper anytime soon. And as we've seen before, higher rates usually hit tech valuations the hardest. So, where does that leave us? We're in a market that's both exciting and incredibly risky. The potential for AI is massive, but so is the hype. And if history teaches us anything, it's that markets don't climb forever. Sløk's message isn't to panic, it's to be cautious. Don't buy into every headline. Focus on companies with real revenue, real infrastructure, and long-term strategy, like NVIDIA, which is arguably the backbone of today's AI ecosystem. But keep your eyes open, because bubbles don't announce themselves until they pop. And this one, it's looking awfully inflated.